Hello everyone, I'm Miles. First, a disclaimer. This discussion is for educational purposes only and does not constitute any investment advice. Today, let's take a look at CRWV. The current stock price is $108, and the market expects significant volatility over the next 18 months. A diligent analyst would consider a core question. Is the good risk-reward ratio enough to justify an investment? The answer is no. Risk-reward ratios show potential profit or loss, but expected value goes further by factoring in probability. Let's use CRWV for an experiment. After research, we see three scenarios. A bull market with a 15% chance, where the stock hits $155, a $47 gain. A base case with a 25% chance, where the stock hits $125, a $17 gain. With a 60% chance of a bear market, the stock drops to $65, a $43 loss per share. Looking only at the risk-reward ratio, with a $47 gain versus a $43 loss, it's about 1.1 to 1. It looks good, but ignores probability. Let's recalculate the expected value. For the bull market, 15% of 47 is 7.05. For the base case, 25% of 17 is 4.25. For the bear market, 60% of minus 43 is minus 25.8. Summing these, the expected value is minus 14.50, an expected return of minus 13.4%. If you only look at the risk-reward ratio, it seems like a decent trade, but once you factor in probability, its expected value is significantly negative. Why? Because the probability of a bear market occurring is as high as 60%. Even if the loss on a single trade doesn't far exceed the gains, the drag from the high probability bear market, negative 25.8, easily wipes out all the gains from the bull market and base case, which add up to 11.3. This is how professional analysts think about problems. Having just one target price isn't called an investment thesis. We must ask further, what is the probability of it rising to 155? And what is the probability of it falling? Probabilities aren't guessed, they come from deep research. That's the analyst's core value. By analyzing fundamentals, competition, financials, catalysts, and risks, they build precise probability distributions. At buy-side firms, analysts evaluate scenarios, quantify potential profit or loss, and determine if the expected value justifies the risk. The risk-reward ratio tells you the odds, the probability tells you the win rate, and the expected value combines the two. A trade that looks favorable in terms of odds could very well have a negative expected value. Returning to CRW, under our assumptions, the expected value is negative, so going long alone is not attractive. But this raises the next question. If we are bearish, how do we learn to design a trade structure that can both express a bearish view and strictly control risk? See you next time.